AP, Bangkok, the start of the year for stocks was mixed, with European averages rising on Monday following a dull day for the few Asian markets open for business after the New Year's vacation. Also closed are U.S. markets. As 2023 begins, there are still ongoing concerns about the conflict in Ukraine and the possibility that interest rate increases intended to control inflation could trigger a recession. This week includes employment data and minutes from the Federal Reserve's most recent meeting. Early trade saw the DAX in Germany rise 0.5% to 13,996.02, and the CAC 40 in Paris rose 0.7% to 6,520.71. Due to the New Year's Day holiday, markets in the US and the UK are closed on Monday. A report released over the weekend revealed that Chinese manufacturing shrank for a third consecutive month in December, the worst decline since February 2020, as the government struggles with a COVID-19 surge across the nation after abruptly loosening anti-epidemic efforts. According to information issued by the National Bureau of Statistics on Saturday, a monthly purchasing managers index fell to 47.0 from 48.0 in November. Numbers under 50 signify a decline in activity. On what would the global economy depend the removal of stringent COVID-19 regulations that stifled the production of goods and raw materials and discouraged travel? Markets are being weighed down by the threat of recession in the US and other major economies, as well as a protracted downturn in China. And certainly, hundreds of millions of people will experience what she described as a recession even in countries that are not experiencing one. However, according to Georgieva, the American economy is remarkably robust and policies like the Inflation Reduction Act and the Child Tax Credit are good for the US and good for the globe. Investors may learn more about the Fed's upcoming steps from the meeting's minutes. On Wednesday, the government will also present its report on job opportunities for November. The weekly unemployment report will come after that on Thursday. The monthly employment data, which is keenly watched, is coming on Friday. In light trading on Friday, U.S. markets added to their losses, bringing an end to the worst year for the S&P 500 benchmark since 2008. The S&P 500 declined by 0.3%. It reported a loss of 5.9% for the month of December and a loss of 19.4% in 2022, or 18.1% when dividends are taken into account. That represents only the S&P 500's third annual fall since the financial crisis of 2008, when it fell 38.49%, and it represents a harsh reversal for investors after the index recorded a gain of over 27% in 2021. S&P Dow Jones Indices estimates that the index's value overall decreased by $8.2 trillion. On Friday, the Nasdaq fell 0.1% and the Dow fell 0.2%. Russell 2000 losses were 0.3%. The Federal Reserve's benchmark lending rate started 2022 at a range of 0% to 0.25% and, after 7 hikes, ended the year at a range of 4.25% to 4.5%. According to the U.S. Central Bank, it won't be cut before 2024 and will reach a level of 5% to 5.25% by the end of 2023. Early in the year, the Russian invasion of Ukraine exacerbated already existing supply chain problems and increased inflationary pressure by causing a spike in the price of commodities including food, gas, and oil. Friday's closing price for oil was roughly $80, or $5 higher than the year's beginning price. But in the interim, oil surged beyond $120, leading energy stocks to record the only gain among the S&P 500's 11 sectors, rising 59%.